everybody. Welcome to Commodity Culture, where our goal is to make you a better investor in the commodity space. My name is Jesse Day. Before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. We bring you the information. You do your own research. And today's guest has over 40 years of experience as an investment advisor, is the author of 10 books, and is currently the managing partner and founder of Oxbow Advisors. We're going to be discussing the broad market. It seems to be very overvalued and due for a correction. We're going to get his thoughts on the role that gold will play up ahead, and if he believes that the narrative of a commodities super cycle on the horizon is valid. It's Ted Oakley. Thank you very much for coming on the show.
You bet, Jesse.
Well, I want to get started with the broad market. As I mentioned, we're currently seeing an overconcentration of big names dominate the indices. You touched on this in your recent market comments at Oxbow, where you wrote, as we enter the mid-year point of 2024, we don't recall a time when the average investor was more befuddled and confused. The idea that everyone can own the same thing, 5 stocks, and all will be happy in the long run is not a very good business plan. We keep hearing that these levels of valuation aren't sustainable, yet these indices, the S&P, the NASDAQ, just keep ticking up, making all-time highs. How much longer can this go on for, in your view?
Well, Jesse and me have already topped. If you look back at all of those stocks, most of them topped, maybe with the exception of one, topped on July 1st. And so here we are, almost the first week in July. So we're almost here at September. And I do think they have topped probably and more than likely. And people keep buying them, but they're going down. If you go look at the percentages on them, they're moving lower. Now, what happens on the concentration is this. In 99 and 2000, we were concentrated, but we were concentrated in like 15 or 20 stocks, maybe 25. They were overvalued, don't get me wrong. But that's the difference between then and today. And today, the concentration comes like this. Everybody's been told to buy an index or buy an ETF by all of these people that have only been in the industry the last 15 years. And so that's what everybody owns. Well, unfortunately, inside those are only 5 or 6 stocks that have been pulling the weight up until the last 2 months, I might add. And that's been the problem. And that's one of the reasons why you see that the indexes will have these big moves, but they're not really making new highs particularly. They're getting close, but they don't really make a new high. So we'll see how it works out. But I think the concentration is in a group of companies that, won't pan out in the long run.
And you've mentioned before, over the past couple of years, that the market is due for a steep correction. How can investors prepare themselves for that scenario? Is now a good time to be in cash, in your view? Or what are some other areas of the market do you personally feel comfortable being invested in when anticipating a large correction in the broad market?
Well, what we've said the last couple of years is not necessarily that we think the market's going to just really, really crash. What we're saying is we can't find any stocks to buy. And there's two different things. We've been about 50% invested. It's not, I know people will think, hey, well, he's out of the market, but we're really not. We're about 50% in, 50% out. The 50% we have out is in treasury. So, we're making 5% or more on it. So we're okay with that for the time being. But we look at it on what we can find valuation wise that fits our parameters. Then we know the market's overvalued. That's what we're saying. We don't just say, hey, it's, it's X, so it won't work. But the other problem is, you can't start a bull market typically at 21 or 22 times S&P earnings. Those don't work. And I know people think that it'll be okay and all of this, but I think investors should look, and this is what we've done in the last 6 months. We own some utilities, which we haven't owned in 6 or 7 years in the growth portfolio. We own some consumer staples. You look at McDonald's, Unilever, those kinds of companies, a couple of drugs, things that we own the growth companies, but we've cut them so far back that they're not as meaningful to us as they would have been over the last 5 years because we sold a lot. We probably sold the big names 5 or 6 times. And now we're down to other things that we're buying. We've owned some gold miners. So we have a mix right now, but what you typically own during poor periods, your utilities, healthcare, consumer staples, and not that they might not go down, but they'll go down a lot less. And so we're still about 50% out of the market, though. So I think investors need to realize if I can get 5% and take some profits, might be a thing for them to look at right now, because most investors don't really understand, to me at least, they don't understand investing anymore. They just look at something on a television screen and say we're up or down, but they don't. In fact, when I ask the question a lot of times, what do you own and why do you own it? I can't even get an answer. So I think that's where we are in the investment world today.
Yeah, it's become a bit of an online casino in many ways, especially with all of the applications currently available that allow people to just trade instantaneously. They hear somebody talking about something in an interview online, they read something on social media, and they just go ahead and hit that buy button without understanding the fundamentals behind what they're doing. Are you seeing, you're mentioning you're seeing that type of kind of fundamental shift behind retail investor behavior? Do you think that has been exacerbated by social media and things like that?
Well, I don't think there's any question about that. If you look, I've got a graph, I don't have it with me, but it just came off last week showing this last run up in the S&P, the second run up after the breakdown. That was the retail investor just piled into those ETFs and indexes on that move, because they've been taught to buy the dips. And so every time that happens, it's interesting because if you watch broadcasting and that kind of thing, when they're broadcasting these things, they'll say, oh, the retail sales are up. That's great for the first time. Well, retail sales, they're flat for like 4 years in a row. They go up and down a little bit, but nothing happens. Wages are not that great. There's so many things that are not that great, but they'll try to put a spin on it. And I think that's where we are today. And people just, they don't know the difference. And so they're all invested. And by the way, if you look at the numbers, I got fresh numbers this morning, we're the most ever as a percentage of investments in equity that we've had on, and when we go back a long way with this, that individuals are that they've ever been.
Wow, I did not know that. I want to get your thoughts on the treasury market, the bond market in general at this point in time. You mentioned short-term T-bills paying 5%. That's a great place to park cash. What are your thoughts overall on the bond market in general? Because there has been that, whether it's a myth or whether it's a reality, I guess depends on the economic environment, but that bonds are kind of the ballast of the portfolio. They will protect you when the broad market goes down. Bonds will act in the opposite way. The 60-40 portfolio, something that is being recommended and employed by retail investors for a very long time now. Could that paradigm be changing? Do bonds still play a role in a portfolio today? And if so, how?
Well, Jesse, I think they play a role, but I think they play a role in the short-term bonds, not the long-term. Now, for us, I'll just tell you what we've done in the last 6 months is we were getting 4 and 5 months ago, we were getting 5% all the way out to 2 years. You could still get over 5 on a 2-year treasury. We took a lot of our floating rate treasuries, not all of them, but a lot of them, and bought 6 month, 1 year, 18 months, and 2 year. We moved out to try to lock a little bit because we felt like the Fed will spook in here and start to, lower rates. And then we also, on a trade, now this is not something we keep long term, but about 7-8 weeks ago, we took a 5% position in the long treasury as a trade. And it's up about 10% by now. We think we'll get probably 20 out of it or 25, maybe more, but it's just a trade. We will not keep it. But I think investor has to realize if they go into the bond market, we're not in a buy and hold bond market anymore because we're not in a period where rates are going to continually come down. Unfortunately, with the Federal Reserve people we have now, they're not unlike Yellen and not unlike Bernanke and Greenspan and everybody else. They're going to make the wrong moves. And so you have to be willing to hold those bonds in a short-term position. I'd say less than 2 years. Individuals ought to think that way, but that would be my advice to them.
And how do you view gold at the moment? You mentioned gold mining stocks a short time ago. When it comes to the metal itself, obviously we've hit nominal all-time highs. Central banks have been accumulating it at a very rapid pace. Some people are saying that's because there's going to be a monetary reset on the horizon where gold is going to be involved in some way or another, whether that's trading between BRICS members nations, for example, or whether it actually returns as money. What are your thoughts on gold here first? And then I'd like to touch on the gold miners after that as well.
Well, I would say to you on gold itself, I think people misunderstand how you handle gold. Like gold is something that you own on long term, okay? Because there's going to be periods where, like 2011, for basically for the next 5 or 6 years, you didn't get any return out of it, and you didn't get any cash flow. That's understandable. That happens, yes. But people forget about what the value of gold is relative to asset value, inflation, and et cetera. Give you an example. If you took the Dow Jones in 2021, all right, that's only 3 years ago, and what it took to buy the Dow in gold per ounces, it takes 20% less gold today to buy the same Dow. Think about that, okay? And I always tell everybody this: you're thinking about it the wrong way. If you go back, 20 or 25 years ago, and whatever it cost to buy a home, for example, with gold, with ounces, if you took those same ounces today, you can buy twice as much as the average home. So it's a thing where you have to hold it through time. And so for us, 2 out of our 3 strategies, we hold bullion. And we hold the miners too, but we hold bullion in those, and we don't sell it. So that's how we approach that.
And when it comes to the mining stocks, we have seen the majors move along with the gold price, Agnico Eagle in particular, hitting all-time nominal highs as well. But in general, especially when we go down to the developers, and then when you get into the higher risk profile, the juniors, the explorers, we haven't seen that much of a move relative to these new all-time highs in the gold price. Do you have any thoughts on why that divergence is? And do you think there's maybe an opportunity there that gap will close as we move forward?
Well, I do think it'll happen. Now, we don't own those. We obviously have to have liquidity, so we own the big names. I mean, if you look at what we own, we do own Agnico, own Newmont, we own Royal Gold, we own a little silver too. But I think what will happen on the juniors and all the smaller companies, obviously they're fairly illiquid at times. What gets those going is that you have a long period when gold and the miners really do well. And when that happens, people gradually start looking at the small ones, and then you have the onslaught, and it becomes, unfortunately, they buy them at the wrong time and they bid them all up and in the end. But we haven't had that yet. And so the miners are still, relative to cash flow, they're still fairly undervalued.
And you mentioned silver as well there. I'd be remiss if I don't pick your brain a little bit on silver. How do you see silver's performance up ahead? Because obviously very far off of its previous all-time highs. A lot of people point to the fact that traditionally in a precious metals bull market, silver kind of eventually plays catch up and then it outperforms, but it lags. In the beginning, some people see it as simply a leverage play on gold. How do you view silver versus gold in a portfolio?
Well, obviously, it's a lot more industrial, so you have to, factor that in. For us, we own less of it, for example, than we do gold. We own 25% of what we would own in total gold in silver, and that's because it's more volatile. But I would say this, relative to where it's been, it's still pretty cheap, and you could see silver over the next 5 years really do well. And you're exactly right, Jesse. What happens is when they play catch up with these, they really run, and you'll see them go up 5, 6, 7 times. And so we own a little bit. It's not as much as we own in gold, but we own some of them.
I want to get your thoughts on this kind of persistent narrative of a commodity super cycle. It's probably a persistent narrative because this whole show is about commodities. So I talk to a lot of people about that specifically. And I've spoken to some who believe that we're going to see a big correction in the broad market at some point, and we're going to see a rotation from overvalued tech into hard assets in the form of commodities and commodities producers. The term commodity super cycles being thrown out there. Some find that hyperbolic, but do you think we could see a massive bull cycle for commodities up ahead? Do you see the same kind of pieces of the puzzle coming together, or is it not quite that simple?
Well, we've said all along we thought that would happen. We formulated something a couple of years ago. We said you won't see a 60-40 portfolio work. It's going to be like more like 30-30-30-10. And by that, we did 30% short-term bonds, 30% real assets, commodities, whatever you want to throw in that category, and 30% value stocks, which you'll have to trade, by the way. But on the commodity side, if you just take the Bloomberg Commodity Index and go back and look at it, you'd think, it's about time for this to start. You don't have to even be a technician. You can just look at the length of time and you look and you think, it's about time for this to do something. I think one of the things people don't realize about commodities in general, really, is we are short so many things as far as supply in the world. Okay. They think it's okay because we're meeting demand. Okay. But if you put any pressure on demand right now for commodities, there's a lot of areas where that price is really going to move on you. And it's a mixed market, and people look at it as well. The grains are down and various things, and it just doesn't work. But in the long run, I think you're going back into a period somewhat of stagflation like the 70s, and the Fed's right in the middle of it now because they're going to lower rates and probably bring back inflation. And so, yeah, I think you have to have. We have a commodity. Obviously, we have some commodities and in two of our strategies. So, we think that's a place you're going to have some exposure.
And the energy sector specifically, are you invested there both in energy producers, oil and gas producers, as well as any of the ancillary companies, the pipelines, the oil field services, oil tankers? Are you seeing any opportunity across the board in the energy space? And if so, where specifically do you currently think is a good place to be?
Well, we have one of our larger percentage allocation right now to energy. Now, let me say this: we don't own the tankers; they carry a lot of debt, they pay a lot of dividends. So you're not necessarily wrong to own them, but we don't own them, and we don't own the service companies. They tend to come and go, but we own production and we own a lot of gas pipelines. And so on the production side, you'll see where we own Conoco, we own Exxon. We own EOG, we own Northern Oil and Gas. Those are things we own on the production side, Williams companies. Then on the cash flow side, pipelines. We own Enterprise Products. We own Energy Transfer. We own MPLX. We own Plains All America on the general partner. So all of those fit, and you can see that's a pretty big allocation for us to energy. But we feel like that's where the cash flow is, so that's where we go.
And I would also like to know if you're looking at all to emerging markets or non-US equities. I think I was talking to Mark Faber recently, and he said it was some massive number of all equity investments in the world currently are in US markets. I think it was north of 50%. It might have even been 70 or something crazy like that. Do you think that will maybe shift? And do you think there's opportunity at all in any emerging markets or just non-North American markets in general?
Well, for sure, because I think Mexico's probably in a bear market. U.S. is going into one, I think. Overseas, Japan we're looking at Japan. We look at some things in Japan. Now, I will say this. We own some emerging market bonds because they were yielding so much more than U.S. paper that it's not a huge percentage, but we do own some exposure to it. But on the stock side, I don't think it's quite the time because we feel like we're in sort of a worldwide recession and really a lot of economies coming under pressure. But if we're going to look out later or even now, we would be looking at companies probably in Japan and to a degree in India, but it's come a long way already. But Japan's one of this kind of situation that's been so down and beat up for so many decades that it's not a bad time to look at it.
So we recently saw jobs numbers in the US be massively revised to the downside. So I wonder, firstly, how are people placing any faith in official government numbers being released on anything? There always seems to be some type of revision. And secondly, what does this latest revision mean for the economic outlook of the U.S. in your view?
Well, on the first question, Jesse, I don't think people should ever trust any of the numbers that come out of Washington, even from the Fed. I mean, they go back and change everything all the time, not just employment, but so many other things. And that's one of the problems. In addition, they leak the info. So if you'll watch anytime something's coming out tomorrow, you'll see the markets move one way or the other today based on that info. Somebody gets that information. But of course, out here in the hinterland, we're never going to know about it. But that's another thing they do that's poor and wrong from that standpoint. But I think that from that standpoint, what you're talking about on the employment coming back and being restated, I think everybody knew it all along, because we kept saying, well, what are you doing this birth-death model? I mean, you're just guessing, boy, how many companies get started, how many companies drop out. You're just guessing. You do a minor survey. It's a joke, really. And I think it's an election year and that kind of thing, so they throw it out there. But I don't put any faith in it. But what it does tell you is that the economy's been weaker than they thought. And all you have to do is go out and talk to people on the street at the lower 50%. And you can figure that out without having to do a big study on it.
Yeah, absolutely. I mean, people's cost of living has gone up considerably. Maybe I'll pivot to inflation here for a moment then and get your thoughts there, maybe focusing on the United States in particular. Fed Chair Powell came out and basically took a very dovish stance recently and claimed that, the inflation is heading where they want to see it. It's going down. Do you buy that? Do you think we could see inflation reemerge? First of all, just as we were talking about government statistics, that there's a website, Shadow Stats, where they show the inflation statistics as they used to be calculated, I believe, in the 70s and 80s, and they've taken so many things out. By that measure, we're much higher. By many other people's, we're even higher than that, depending on what products you're buying, et cetera. Everybody's lifestyle, it'll depend. What are your thoughts on inflation moving forward? Are we going to see a resurgence? Inflation, obviously, I'm sure you believe as well, is far worse than the numbers they're stating. How do you see that whole picture?
Well, Jesse, I think Chairman Powell and the rest of that committee are following right in the footsteps of Bernanke, and to a degree Yellen, but to Bernanke when he told you that everything's okay, we're not going to have it, nothing's going to go wrong, so don't worry about it. What you're seeing out there is not correct. We're really hitting our targets and everything, and that was late 2007, and they never could see what was happening until it was too late. I think it's similar with this group. I think you look at it, inflation's 3.3. That's 65% above his quote-unquote 2% target. How do you get to a 2% target if you come back in now and start loosening the money up, and all of a sudden people start borrowing more, spending more? So they run the risk, and it's a fairly high risk, of the second go-round. Now, maybe in the short run here, they take the rates way down. We go into a tough recession. I could see that, really, take them way down again. But to me, that'll be the last time you get a shot at it, because the aftermath that will be more spending, more inflation, and you'll spend the next 10 years. I think Wall Street will scratching their heads because they don't know how to deal with it right now.
So you're 50% in cash, which seems like a pretty considerable percentage. If we're looking at a potential correction up ahead in the broad market, you said you don't necessarily see a crash, but you do think these stocks are overvalued. So how much of a correction do you think we could see? What is the point where you would say, okay, there's blood on the streets, we're seeing some really big discounts out there, now is the time to start deploying some of that 50% cash? How much, where would the market have to be at for you to say that? And where would you be looking for value in that circumstance?
Well, if you think about it, okay, and I'm just going to use a multiple. Let's say the multiple is 21 right now in the S&P 500, and needs to be 14 or less for us to think it's really cheap, because a lot of times it's been 8 or 9. Let's just say 14 or less. That means you're 35 or close to 35% overvalued. Now, could you go down 35? Unquestionably. You could go down 50 off of this kind of market, because you're so concentrated. So many things can happen. So many things could happen worldwide that changes the look. But I certainly think that it wouldn't be abnormal at all for us to break back 25 or 30%. And not because I'm looking to try to time that or something like that, but I think that's where you have to get to before the companies are really, really cheap. I mean, all you have to do is look at Warren Buffett. If they were really, really cheap, believe me, he'd be adding some names right now. But they're not cheap, and so yeah, the market's going up. But again, it's skewed toward a few things, which skews the averages, which the average person cannot tell the difference between the average and what's really going on under the market.
So is this maybe a time to start doing due diligence on quality companies? Because in this sort of correction, we obviously will see all names across the board drop. I'm sure we'll see even gold go down and gold miners, commodities as well in that initial sort of sell-off. Is this a time to start doing that due diligence, have a shopping list ready of quality company names, and then if you see that correction in the market, kind of step in and start allocating capital? What are your thoughts?
Well, we do. I'll put it this way. We screen continually 200 to 250 companies. You could call that a shopping list, but what that screen consists of are companies that don't have a lot of debt, we think can make over 15% a year the next 5 years, that have good management, that have handled the books right. We look for those kind of, now a lot of those are too expensive right now, but that's our shopping list. That's what we're looking for, okay? And one of the things we look for on that shopping list is when we discount that next 5 years on an inflation number, typically what we're trying to do is buy 20% under that number. So you can see, what you're trying to do is give yourself a lot of protection so that when you buy, you're not going to get hit really hard. And I think that's what people need to understand, that, yeah, it wouldn't be a bad idea to know some companies right now, because that's where you'll make the most money. We don't get negative and bad markets. We get positive, actually. That's when you make the most money. So view that as opportunity. But I've said it before, you can't have any opportunity, Jesse, if you don't have any cash. And that's just the way it is.
Yes, fantastic insights there in this whole conversation. I've learned so much. Thank you so much, Ted. Really appreciate it. For those who want to learn more and hear more from you, tell us about what you do at Oxbow Advisors. I know you also have, I believe, a YouTube show, a podcast as well. So tell us about that too.
Well, if you come to the website, which is oxbowadvisors.com, you'll see everything. You'll see the interviews we do. We'll see all the books we've written, working on a new book right now. And you'll see our market letter. We really are very transparent. We're not trying to, we're not always right. But if one of the things we can do is make an adjustment if we really feel like we've made an error, and we make some errors. But one of the things that come in the website, you'll see everything. Now, if you go to YouTube, everything we do, including this, would be on the YouTube channel. Anybody we interview or anybody that interviews us. Also, our chief investment officer, who is a brilliant guy, Chance Finucane. I really recommend you to listen to what he has to say about particular stock picks. And so that's the place to go. I think today there's so much information out there, Jesse, that investors get fed too much. I think what you'll find with Oxbow is that we're real simple, and you won't have to worry about not understanding it, because we make it so you can understand it.
That's fantastic. I'll put a link in the description below to both the Oxbow Advisors website as well as your YouTube channel, so people can subscribe there as well. Thank you once again, Ted, for coming on and sharing your knowledge with the audience.
All right, Jesse. Thank you. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.